Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Worthington Steel Inc. quarterly report. Worthington Steel Inc. provides a range of steel processing services to various industries across North America. At the core of its operations are carbon flat-rolled steel and Taylor welded blanks, which cater to diverse sectors such as automotive, construction, machinery, heavy truck, agriculture, and energy. The company's product offerings also include aluminum Taylor welded blanks, further expanding its capabilities in metal processing. Additionally, it provides specialized services through automotive and electrical steel lamination stampings, underscoring its expertise in precision metal fabrication. Worthington Steel's comprehensive range of products and services positions the company as a key player in the North American steel processing market, serving a broad spectrum of industries with high-quality materials and tailored solutions. Worthington Steel, Inc. market capitalization of $2 billion is materially smaller than most of its industry peers of roughly $4 billion. Worthington Steel, Inc. trades at a lower price-to-earnings ratio of 15 times and a higher price-to-book ratio of 1.55 times relative within the industry. Despite the industry trading at relatively low valuations, the stock matrix does not show much. Investors should evaluate if the business has potential earnings that is sustainable and if the assets are valuated rationally. The company maintains a moderate leverage profile, with liabilities making up 39% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline in a company's financial performance can be attributed to several key factors. Revenue growth is primarily driven by increased demand for steel products, which leads to higher sales and revenue. Additionally, pricing trends for raw materials and finished goods also play a significant role in revenue growth. The expansion of product lines and participation in new markets further contribute to revenue growth. Furthermore, the company's transformation and innovation efforts are expected to yield benefits that will positively impact revenue. On the other hand, revenue decline is primarily driven by lower toll spreads and unfavorable changes in toll mix. Softening demand from mill customers also contributes to revenue decline. The closure of a processing facility and disputes related to steel imports further exacerbate revenue decline. In some cases, revenue remains stable due to various factors. For instance, the company's net sales for 3 months ended February 28, 2026 were stable compared to 2025. The net income of the company experienced a significant decline between 2022 and 2023, decreasing by $22.2 million to $123.4 million. However, this trend was not consistent in subsequent years. For instance, when comparing 2025 and 2026, the 3-month period saw a decrease in net income, while the 9-month period showed an increase of $10.5 million. The profit margins also underwent changes during this period. The gross margin decreased by 1.9 percentage points to 9.9% for the 3 months ended in 2026 compared to 2025, and by 0.3 percentage points to 11.3% for the 9 months ended. Similarly, the operating income margin declined by 2.3 percentage points to 0.4% for the 3 months ended, and by 0.7 percentage points to 2.9% for the 9 months ended. The reasons behind these changes in net income and profit margins can be attributed to several factors. The increase in depreciation and amortization of $14.5 million had a negative impact on the company's profitability. On the other hand, the decrease in impairment of assets by $5.3 million contributed positively to the net income. Additionally, the rise in equity in net income of unconsolidated affiliate, net of distributions, by $6.8 million also played a role in the fluctuations observed during this period. The company's financial performance indicates a stable trend in generating positive operating cash flow. According to the provided data, net cash provided by operating activities has shown a slight decrease from $176.4 million in 2025 to $156.3 million in 2026. However, this reduction does not necessarily indicate a negative shift in the company's financial health. In fact, consistent confirmation of positive operating cash flow can be found on pages 20 and 59, further solidifying the notion that the company is generating sufficient cash from its core operations to support its growth and activities. This trend suggests that the company has a strong foundation for long-term sustainability and stability. The company's debt level has undergone significant changes over the past year. Initially, long-term debt decreased by $29.3 million from $31.6 million to $2.3 million. However, new debt financing commitments of up to $1.9 billion were obtained, which increased the total debt outstanding to $247.1 million. The carrying value of the credit facility also increased from $149.2 million in 2025 to $192.7 million in 2026. In terms of interest expenses, there are conflicting reports. On one hand, interest expense net decreased from $1,400,000 in 2025 to $2,100,000 in 2026, indicating a decrease. On the other hand, interest expense increased by $700 million and $1,600,000 for the 3 and 9 months ended February 28, 2026, respectively. Additionally, interest expenses have increased significantly by $700 million from 2025 to 2026, and interest expense has increased by 26.2%, $1,600,000, from $6,100,000 to $7,700,000. Overall, the company's debt level has decreased in some instances but increased in others, while interest expenses have shown mixed results, with both decreases and increases reported. Management is optimistic about the company's future prospects. They expect to achieve cost synergies and accretion to earnings per share after the acquisition of Klöckner, which will enable them to expand and grow operations through strategic capital expenditures. The proposed acquisition is seen as a strong strategic fit that will create a diversified metals processing leader with an enhanced product offering and broader geographic reach. Management also highlighted their strategy of investing in market share expansion, talent, technology, and capital expenditures. They are experiencing share gains in the automotive industry due to new programs and a key OEM customer returning to normal production levels. Additionally, they expect to benefit from lower interest rates on credit facility due to benchmark rate cut, and sales are strongest in fiscal fourth quarter and weaker in third quarter due to seasonal activity. The proposed acquisition is expected to be transformative to the company's portfolio, scale, and long-term operating profile. Management believes that this acquisition will have a significant impact on the company's performance, but they exclude related expenses from adjusted results to facilitate period-to-period comparisons. The company has adequate resources to meet its needs for at least 12 months and for the foreseeable future, and intends to fund the proposed acquisition with a combination of cash on hand and new debt financing. Overall, management is confident about the company's outlook and strategy, which includes expanding market share, investing in talent and technology, and growing operations through strategic capital expenditures. The proposed acquisition of Klöckner is seen as a key driver of this growth and will enable the company to become a diversified metals processing leader with an enhanced product offering and broader geographic reach. The company has made several strategic moves through acquisitions and divestitures to restructure its business operations. Acquisitions have been a key part of the company's growth strategy. Notably, the Sitem Group was acquired, which is mentioned in 2 separate pages of the summary. Additionally, there was a proposed acquisition of Klöckner, although it is unclear if this deal was completed. On the other hand, divestitures have also been an essential part of the company's restructuring efforts. One significant move was the separation of Worthington Enterprises' steel processing business into a standalone company called Worthington Steel on December 1, 2023. This decision aimed to streamline operations and focus on core businesses. The company has also divested its remaining net assets in October 2022, marking another significant step towards restructuring. Furthermore, the sale of WSCP's facility in Cleveland area was completed in May 2025, while the sales of substantially all of the remaining net assets of WSCP's Cleveland toll processing manufacturing facility were also carried out. Lastly, the company sold its assets for $16.6 million, net of selling costs, as part of its ongoing efforts to restructure and optimize its operations. These divestitures demonstrate the company's commitment to streamlining its business and focusing on core activities. The company's financial reports reveal a consistent history of paying dividends to its shareholders. The most recent dividend payment for 2026 amounts to $24.6 million, while the previous year saw a payout of $23.9 million. This indicates a steady commitment to rewarding investors through dividend distributions. Furthermore, the company has declared quarterly cash dividends per common share at a rate of $0.16 in both 2025 and 2026. These declarations were made on March 25, 2026, and demonstrate the company's intention to maintain a stable dividend policy. In contrast, there is no evidence to suggest that the company has engaged in share buybacks during this period. The absence of any mention or indication of share repurchases in the provided financial reports suggests that the company has focused on distributing dividends rather than buying back its own shares. That concludes the financial summary for Worthington Steel Inc. Feel free to comment below, and I will be happy to answer them when possible.